So what could a protracted standoff between the U.S. and China mean for both stocks and bonds? We have two guests with us tonight covering stocks. It's Sarah Hunt. She's portfolio manager at Alpine Woods Capital. And on bonds, it's Mark Grant. He's chief global fixed income strategist at B. Riley FBR. Good to see you both. Thanks for joining us tonight.
Thank you.
Sarah, what about, well, you heard Mike Santoli talking about that. Do you see the market becoming more defensive? Is that where you might be putting money to work right now, do you think?
I think that the market definitely has become more defensive. If you look at some of the multiples on consumer staples, if you look at the defense stocks, which have recovered quite nicely after a sell-off last year, that wasn't just about the December quarter. The defense stocks were having a hard time all year last year. So I think that you're starting to see people position themselves more defensively. People are looking at places where there's more U.S. exposure.
And you know, Mark, one of the places that they are getting defensive is by moving into the bond market. How much more of this move do you see? And if you're a longer term investor, would you go out as far as the 10-year, or would you be shorter on the yield curve?
So I've been saying for quite a while that yields were going down. The 800-pound gorilla in the room, of course, is the Fed. The Fed made, choose a word, an about face, 180-degree turn, a flip-flop after their December meeting. And I think the Fed's next move is going to be, because of the Chinese, what I call it the Game of Thrones between the two countries, the Fed's next move is going to be to cut interest rates. I would like to point out, when we're talking about China, it's not like China is equivalent to the United States. The Chinese economy is 41% smaller than the U.S. economy. And consequently, any kind of protracted trade war, I think, is going to hurt China far more than it's going to hurt the United States.
How much lower, though, could you see yields going? Give us the 10-year. We're at 230 right now.
I think we could get down to somewhere around 2%. It wouldn't surprise me at all. I think the Fed is very conscious of the what's going on with China. I had a great opportunity not long ago to speak with the president of the St. Louis Fed, Jim Bullard, one of the brightest guys on Wall Street, in my opinion. And he didn't, of course, say anything,
right,
but it was my impression that the Fed was very concerned about the U.S. economy and the trade wars and was ready to go either way, depending upon how things worked out.
So, Sarah, given the uncertainty and the headline risk, if you're a longer-term investor, what areas of the market do you think look a little bit safer?
Well, again, I think if you go back to some of the areas that have already seen some pretty good appreciation in prices, so I'm not sure you want to jump into things like consumer staples here, but I think over the longer term, I think you still have some really good opportunities in some of the defense stocks. I also think some of the consumer stocks, I mean, there are issues in terms of pricing with Home Depot and things along those lines where you might have to worry about tariffs, but longer term, those are stories that have really had very nice growth over long periods of time, and I think that that ultimately is going to continue.
Let me just say, I had lunch with an investment banker friend today, Sarah, and his opinion was, and it's one man's opinion, oh, they'll figure things out. So he would be stepping in to buy those things that have been selling off, like the semiconductor stocks and some of the other companies that have been suffering because of the trade war. Is that risky thinking, or what do you think about? I mean, this has been a market that's been buying dips for years now.
Well, I think that it depends on your time frame. If you have a long enough time frame, it's absolutely a great idea because in the end, they will figure it out. The question on the technology side is which stocks are going to be specifically impacted. And I think that if you can get comfort that the places that you're looking have at least a less exposure to the issues that are going on, then it's not such a difficult thing. And I think longer term, I mean, we're all going to be using more semiconductors. We're all looking at more data. All of these things, these trends are not going to stop just because we get into a trade war.
Sarah Hunt with Alpine Woods Capital and Mark Grant with B. Riley FBR. Thank you both tonight.
Thank you.
Thank you.